Today we're going to look at the company Universal Music Group, headquartered in the United States and traded on the OTC, over-the-counter, markets, under the ticker UNVGY. Please stay tuned for the important disclosure information at the conclusion of this video. The story of Universal Music Group is a saga of industry consolidation and resilience, tracing its origins back to the 1934 formation of Decca Records. For much of the 20th century, the company's identity shifted through various owners, most notably MCA, before the Universal name took center stage in 1996. The most transformative era began in 2000 when the French conglomerate Vivendi acquired the group, merging it with Seagram to create a global media powerhouse. Throughout the early 2000s, Universal Music Group navigated the turbulent collapse of the physical CD market by aggressively acquiring competitors, most notably its $1.9 billion purchase of EMI's recorded music division in 2012. This strategic move solidified its position as the world's largest music label. Vivendi's financial reports from this era show a company that was initially bleeding revenue due to digital piracy, but eventually found its footing as the streaming revolution took hold around 2015. Under the leadership of Lucian Grange, Universal Music Group transitioned from a legacy record label into a diversified content giant. After 2 decades as a crown jewel within Vivendi's private portfolio, the company finally achieved independence in 2021 with its landmark listing on the Euronext Amsterdam. This IPO marked the end of the Vivendi era and the beginning of Universal Music Group's chapter as a standalone public titan. Universal Music Group operates as the ultimate gatekeeper and engine of the global music economy, utilizing a business model built on the long-term monetization of intellectual property. At its core, the company is divided into 3 primary pillars: recorded music, music publishing, and merchandising. The recorded music division is the most prominent, encompassing legendary labels like Interscope, Capitol, and Republic, which discover artists and manage the production and distribution of their work. Complementing this is Universal Music Publishing Group, which manages the rights to the underlying compositions, the lyrics and melodies, ensuring that songwriters are paid whenever their music is performed, broadcast, or synchronized in films and advertisements. The customer base for Universal Music Group is remarkably diverse, ranging from individual fans purchasing vinyl and concert tickets to massive digital service providers like Spotify, Apple Music, and YouTube, which pay licensing fees to access Universal Music Group's vast catalog. Furthermore, the company has increasingly turned towards social customers, licensing music to platforms like TikTok and Meta, and brand customers who seek iconic tracks for global marketing campaigns. Geographically, Universal Music Group is a truly borderless enterprise. While the United States remains its largest market, the company has aggressively expanded its footprint across Europe, Asia, and Latin America. By investing heavily in high-growth territories like China, through partnerships with Tencent and India, Universal Music Group ensures it isn't just exporting Western hits, but actively developing local talent to dominate regional charts, thereby capturing the global rise of streaming across every continent. The 2-decade arc of Universal Music Group is a masterclass in industry adaptation. In 2006, Universal Music Group was grappling with the Napsterization of the industry, where digital piracy decimated high-margin CD sales. For nearly a decade, the recorded music segment faced a steady decline, bottoming out around 2011. During this lean period, Vivendi used Universal Music Group's cash flow to acquire competitors, most significantly buying EMI's recorded music assets in 2012. This was a high-stakes bet that a consolidated market would eventually recover through legitimate digital alternatives. The turning point arrived in 2015 with the global mass adoption of paid streaming. For the first time in 15 years, Universal Music Group saw its recorded music revenues pivot from decline to aggressive growth. As Spotify and Apple Music scaled, Universal Music Group's massive catalog, the largest in history, began generating passive, recurring revenue, effectively turning music into a utility. This shift also boosted the music publishing division, which grew from a steady background contributor into a multi-billion euro engine as performance and mechanical rights became more enforceable in the digital age. By the time Universal Music Group transitioned into a standalone public company in 2021, the business model had been completely de-risked. The post-IPO era has seen revenues surge past the 10 billion euro milestone, fueled not just by Western superstars like Taylor Swift, but by a strategic push into high-growth international markets. Today, the company is diversifying further into merchandising and expanded rights, ensuring that whether a fan streams a song, buys a limited edition vinyl, or watches a branded TikTok, Universal Music Group captures value. The estimated 2025 revenue of 12.6 billion euros represents a near tripling of the company's size since its low point, marking the successful completion of its digital rebirth. The financial history of Universal Music Group over the last 20 years is a narrative of profound industrial transformation, moving from the brink of digital irrelevance to a high-margin, recurring revenue powerhouse. In the mid-2000s, Universal Music Group operated in an environment where physical CD sales were collapsing and digital piracy was rampant. During the years between 2006 and 2014, revenues were largely stagnant or declining. Because the music industry had high fixed costs related to physical distribution and manufacturing, these cost of goods sold, COGS, remained heavy, often consuming over 55% of total revenue. Sales and marketing, S&M, expenses were also significant as the company fought for visibility in a fragmenting media landscape. Notably, research and development, R&D, is typically not reported as a separate line item for music labels, as discovery is captured within artist and repertoire, A&R, costs inside COGS. As we move into the streaming era, starting around 2015, the cash flow dynamics shifted dramatically. The transition to digital streaming via platforms like Spotify and Apple Music allowed Universal Music Group to shed many of the costs associated with physical inventory. While artist royalties, which scale with revenue, kept COGS high, the predictability of subscription income allowed for better operational leverage. During this period, working capital, WC, became a more active management tool. The table reflects a consistent working capital change, which in the music business is often driven by the timing of massive royalty advances paid to superstars. These are balanced by contract liabilities, which represent upfront cash collected from digital platforms that has not yet been recognized as earned revenue. This cash-first model is a secret weapon of the modern music business, providing a buffer of liquidity that traditional retail models lack. The most jarring shift in the data occurs around the 2021 spin-off from Vivendi. As a standalone entity, Universal Music Group began reporting high levels of stock-based compensation, SBC. This is a non-cash expense used to align executive and employee interests with shareholders, but it creates a wide gap between accounting free cash flow, FCF, and actual cash available to investors. In 2022, for example, SBC reached 562 million euros, significantly eating into the FCF when adjusted. However, by 2024 and 2025, Universal Music Group has successfully optimized its strategic organizational redesign, bringing these non-cash costs down and allowing FCF minus SBC to rise significantly. This indicates a company that is not just growing its top line, but becoming leaner and more efficient in its conversion of revenue into real, distributable cash. The projected 2025 performance shows a company at its zenith, with revenues nearing 12.6 billion euros and an operating cash flow exceeding 2 billion euros, cementing its status as the world's leading music entertainment company. The financial story of Universal Music Group over the past 2 decades is defined by its transition from a reliable cash cow for its parent company, Vivendi, to an independent, strategically aggressive public entity. Between 2006 and 2011, Universal Music Group operated as the dominant segment of Vivendi's portfolio, where its primary mandate was generating stable cash flow to support conglomerate-level dividends. During this phase, strategic acquisitions were relatively small, focused on regional labels and niche catalogs, while the company's debt remained low, as most financing was handled at the Vivendi Group level. A paradigm shift occurred in 2012 with the landmark acquisition of EMI's recorded music division for approximately 1.4 billion euros. This move required a significant jump in financing debt, which more than doubled to 2.4 billion euros. This acquisition was a generational bet on the consolidation of the music industry right before the streaming revolution began in earnest. Following this, from 2013 to 2019, Universal Music Group entered a period of debt digestion and organic growth, where its free cash flow steadily expanded alongside the rise of Spotify and Apple Music. During these years, dividends paid up to Vivendi grew in tandem with Universal Music Group's rising earnings, reaching 720 million euros by 2019. The most transformative period for the balance sheet began in 2020 and 2021. Preparing for the spin-off, Universal Music Group reconfigured its capital structure. The company's free cash flow, FCF, in 2021 shows a sharp dip when subtracting stock-based compensation, SBC, which was used heavily to incentivize leadership during the Amsterdam listing. Post-listing, Universal Music Group formalized a policy to return at least 50% of net profits as dividends. This resulted in the total dividend payout jumping to nearly 1 billion euros by 2025. Strategic acquisitions also spiked during this period as Universal Music Group aggressively purchased iconic song catalogs, such as the Bruce Springsteen and Sting deals, which are reflected in the high strategic acquisitions outflows in 2022 and 2023. In the current era, Universal Music Group has matured its capital allocation. For the first time, we see the introduction of stock repurchases as a secondary method of returning value, alongside a moderating pace of catalog acquisitions as interest rates rose. The financing debt column, strictly reconciled against Universal Music Group's, shows a managed increase to approximately 3.35 billion euros. This debt is strategically laddered with long-term maturities, reflecting the company's confidence in its recurring, subscription-based streaming revenue. As of early 2026, Universal Music Group sits on a robust cash pile of over 1 billion euros, providing it with the dry powder necessary to continue its artist-centric strategy while maintaining its commitment to growing shareholder returns. Universal Music Group is steered by Lucian Grange, a titan of the music industry who has served as the company's chairman and CEO since 2011. He first joined the organization in 1986 to launch Polygram Music Publishing in the UK. Over 4 decades, he rose through the ranks, overseeing UK and international operations, before taking the global helm and eventually leading Universal Music Group through its landmark 2021 public listing in Amsterdam. For the 2024 fiscal year, Grange's compensation reflected his status as the industry's highest-paid executive. His base salary was approximately 5 million euros, while his total remuneration reached 37 million euros. As for ownership, institutional investors own roughly 61% of the company, while the general public and smaller investors hold the remaining free float of approximately 20%. Individual insider ownership, primarily held by top executives and directors, is estimated at about 19%. Unfortunately, the liquidation value of the company is negative. Let's build a scenario-based dividend discount model. The bull case, the superfan and AI renaissance. The bull case envisions a world where Universal Music Group fundamentally re-rates its value. Catalysts include the widespread adoption of super premium streaming tiers that successfully monetize the top 10% of fans at 5x the standard rate, a model already proven by Tencent Music in China. Simultaneously, Universal Music Group leverages AI to drastically reduce A&R and marketing costs while aggressively licensing its vast catalog for AI training and user-generated content. In this scenario, revenue growth accelerates, and operating margins surge toward 22% as the cost of talent is partially offset by high-margin technology licensing. The base case, the steady compounding utility. In this scenario, Universal Music Group successfully transitions to a music utility model. Revenue growth is driven by consistent, modest price increases from streaming platforms and the continued expansion of the middle class in emerging markets like India and Brazil. The company's strategic organizational redesign delivers its promised €250 million in annual savings, which, combined with the inherent operating leverage of digital distribution, pushes margins into the high teens. Capital allocation remains balanced, with a commitment to pay out at least 50% of net profit as dividends while making selective, mid-sized catalog acquisitions to maintain its dominant 30% plus market share. The bear case, the fragmented frontier. The bear case assumes a death by 1,000 cuts, where the global streaming market reaches saturation faster than expected, and price increases face severe consumer pushback. Competitive pressure from independent distribution and AI-generated mood music begins to erode the market share of major labels. Catalysts include a regulatory crackdown on royalty splits and a significant decline in the cultural hit-making power of legacy labels. In this scenario, Universal Music Group must spend more on acquisitions just to stand still, leading to stagnant dividends and a higher reliance on debt to fund catalog purchases. In the bull case scenario, we assume the following: revenue growth at 11%, operating cash flow margin at 22%, capex growth at 3%, stock-based comp reduces at 3%, dividends growth at 14%, stock repurchase at 10%, acquisition spending in the next 20 years at €12 billion. Stock repurchases assumes price-to-sales ratio of 3. With this discounted at 7.5%, dividend model yields $13 worth of value per share in 20 years, $29 in 30 years, and $59 in 40 years. In the base case scenario, we assume the following: revenue growth at 7%, operating cash flow margin at 17%, capex growth at 5%, stock-based comp growth at 0%, dividends growth at 9%, stock repurchase growth at 7%, acquisition spending in the next 20 years at €8 billion. Stock repurchases assumes price-to-sales ratio of 3. With this discounted at 7.5%, dividend model yields $8 worth of value per share in 20 years, $13 in 30 years, and $19 in 40 years. In the bear case scenario, we assume the following: revenue growth at 4.5%, operating cash flow margin at 14%, capex growth at 6%, stock-based comp growth at 2%, dividends growth at 3%, stock repurchase remains stable, acquisition spending in the next 20 years at €7 billion. Stock repurchases assumes price-to-sales ratio of 3. With this discounted at 7.5%, dividend model yields $4 worth of value per share in 20 years, $5 in 30 years, and $6 in 40 years. Thank you so much. Research like this takes a lot of time. If you enjoyed it, please like, subscribe, and consider supporting us. Please note that this video is for entertainment purposes only. We are not financial advisors. This video is not financial advice and should not be considered as such. This video does not provide any recommendations and does not endorse any decisions to buy, sell, or hold any security. We do not guarantee the accuracy or the completeness of the data provided in the video. We are not responsible or liable for any decision, damages, or losses the viewers may take or incur due to negligence or otherwise, based on any interaction, directly or indirectly, with this video. Past performance is not an indicator of future returns. The viewers are encouraged to seek independent legal, financial, taxation, or other professional advice for any action they might take.